Hey everyone, welcome to another week of KNR 455. This week our topic is on valuation. So basically what we're going to be looking at over the course of this unit is valuation, which is a process of estimating the value of either individual assets owned by a sport organization or the sport organization itself. So that will be our topic for this week. Again, we always start with why, right? Why might this be important to us as sport practitioners? And I think oftentimes we hear this concept of valuation in relation to the value of a sports team or league, right? You hear in the news, Team X sold for, $3 billion. And that's often how this concept of value is portrayed to us in the context of sport. But there are many other aspects of the sport industry that require valuation. And in all likelihood, at some point in your career, you will be tasked with determining the value of a sport related asset. So, because of that, it is important that you understand the various approaches to valuation as well as some key standards that are used in this process. So, that will be our focus here today. Okay, so let's start by defining this concept of valuation. And we'll kind of start broad and then get a little bit more specific in terms of the sport industry. And typically, before I even define this term valuation, I start with the root word, right, which is value. So, value is the estimate of monetary worth, right? And keep in mind, valuation is the estimate of that value. So, this concept of valuation is a process that we go through in order to estimate the value of an asset. You could also refer to valuation as an appraisal, right? And essentially another word for it, the act of assessing the value of something. But we'll refer to it as valuation for the purposes of our class. Now, in sport, we can value both an enterprise itself. So, when you see the term enterprise valuation, basically they're talking about the business or sport organization. Or we can also value individual assets, as I said before. And typically, these assets would be owned by some kind of sport organization. So, what are some assets that sports teams own that might have value and therefore we could calculate the value of? Well, the list kind of goes on and on, right? If you kind of brainstorm in your head, you could start with the team itself, obviously, having value. The stadium or arena that the team plays in, obviously, has value, especially if the team owns it. The players themselves certainly have values, the athletes on the field or on the court. Space where sponsorship signage goes has value and therefore can be valued. Ticket packages have value, concession contracts, television broadcast deals. You get the idea. We could go on and on here, but there are a number of things, individual assets that sport organizations own that have value to them and therefore require valuation. So valuation isn't just something for owners to be concerned about, right? Certainly they are, and likely most concerned about the valuation of the team itself. But entry level sport practitioners also need to be able to calculate the value of various assets in order to generate revenue for the team and to be successful in their jobs. Okay, so in order to understand the process of valuation, we have to have a basic understanding of value and the various standards of value. So let's start with this concept of fair market value. Fair market value is the price a buyer is willing to pay under ordinary circumstances, taking into account everyday normal situation. So I always like to use the car example, right? So when you go to buy a car, you're looking to pay fair market value, right? And the following has to exist in order for that fair market value price to exist, right? You have to have both a willing buyer and a seller. Neither party can be under any kind of compulsion or pressure to buy or sell. Both parties have to have reasonable knowledge of facts, right? Anytime you go buy a car today, you probably do a little bit of research before you go in terms of looking at the Kelley Blue Book price and looking at other sale prices at different dealers. So generally, both the buyer and seller go in with a kind of a baseline of facts. And then both parties are at an arm's length. Now, what does this mean? Well, arm's length basically just means that both parties are acting independently of one another and the two don't have any kind of relationship with one another. So both parties are acting in their own best interest. If you go to buy a car from a car dealer, most likely this sort of requirement would be met, right? You probably wouldn't know the person you're buying the car from. Now, if you were going to buy a car from your grandpa, that might not be the case, right? Your grandpa, you have a relationship with, he might want to give you a good deal on the car. So the price that you would pay for that car is probably going to be less than fair market value. Okay, so when we see valuations of sports teams, typically we are seeing, some variation of fair market value because they are taking into account normal everyday circumstances. But we can also just think of fair market value as a baseline value of sport enterprise or asset. There are going to be other adjustments to value that will likely either inflate or deflate that number depending on different factors in the situation. When the Cubs are doing well and winning games and making the playoffs, the prices of those tickets tends to increase, right? And that's because demand is going up. That demand is one of these factors that might impact fair market value, right, and make it increase. So that's just one example of how some of these external factors might impact fair market value. Okay, so there are some other standards of value that we need to discuss. Fair market value, I want you to think of as just this baseline, right? And knowing that that baseline is likely going to change based on some different standards that we're going to apply. So strategic value, first of all, you can see here, is a value that a buyer would be willing to pay in order to obtain the assets because it has the ability to use those assets in a way to get more value out of them than a typical buyer would. Basically, some companies are going to be willing to pay more for a particular asset than others would because they know they have the ability to use those assets in a way to get more value. We see this oftentimes in a sport season, as the playoffs are coming up. A team makes a trade for a player, they sign a pretty big deal just for a 1-year arrangement with that player. And they're willing to pay more for that player than, say, a team that didn't make the playoffs because of strategic value, right? They know that they have the ability to gain a lot from signing that player, and therefore they're willing to pay the extra amount. The same concept can apply to a range of other assets, right? I always think of Anheuser-Busch as a good example of using strategic value, right? Because their U.S. headquarters are in St. Louis, they have this sponsorship relationship with the Cardinals, and it's a great example of strategic value, right? Because they are headquartered there, they're willing to pay more than, say, a company like Miller is, right, for that sponsorship because they want to take advantage of their ability to both have their headquarters there and be, this headlining sponsor for the baseball team in town. So they can capitalize on that brand exposure and therefore willing to spend more than, say, other beer companies would. As you can imagine, strategic value is typically going to be higher than fair market value, right? If fair market value is our baseline, strategic value is going to increase that number, right? Because the investor sees the upside potential of that investment. They know they're going to make more money in the end, and therefore they're willing to pay more upfront. So, as a sport practitioner, you have to be aware of the strategic value of your assets. And like I said, teams do it with individual players. There are a number of different ways you can apply strategic value. Okay, liquidation value is another standard that we need to identify. Obviously, we remember this term liquidation, right, from our unit on financial ratios. If we sort of go back into our memory, we remember that this term liquidation basically means the ability to turn your assets into cash quickly, right? So if you think about it, the value of assets when they are sold, so let's say a company goes bankrupt and they have to sell off their individual assets. Liquidation value of those assets is if they're being sold separately rather than together, right? So for example, let's say a sporting goods store goes out of business, has to sell off all its assets separately. So not just its products, but its store assets, cashier equipment, tables, racks, it could go on and on. So liquidation value might actually have the opposite impact of strategic value, right? Meaning that the value might actually go down below fair market value if the assets are sold separately, right? If a fitness center owner can't sell the gym as an enterprise, as a full concept, they're probably going to have to sell the equipment on its own, which could lead to a decrease in value. And regardless, those pieces would have what we call liquidation value. And typically in those situations, the owner's also trying to sell fairly quickly, which does not help in terms of increasing value. Okay, one last standard of value here I want to mention is depreciation value. So here we're looking at the allocation of an item's loss of value over a time period. Let's go to the next slide here and we'll talk a little bit more about depreciation value. So we've all encountered this concept of depreciation at some point, right? You buy a car, you drive it off the lot, and its value depreciates immediately, right? Over time, assets lose value, right? The further away you get from the purchase point of an asset, generally it loses value over time, and that goes for really any kind of sport-related asset. So you might be asking, why do we care about depreciation value? Well, it turns out you can actually deduct depreciation value on your taxes. So if you're a sport organization with a lot of equipment at your facility, that equipment's losing value over time. If you take the time to calculate depreciation value, this could save you money each year on your tax bill, right? So a lot of sport organizations will prioritize, determining depreciation value when it comes time to do the taxes because of, the ability to save some cash there. So your textbook talks about a number of methods for determining depreciation value and what you can actually deduct on your taxes. I'm going to focus on this first one, which is straight line depreciation. You can certainly review the others, but this one is the most straightforward and I think gives us a good look at what depreciation value is. Okay, whoops. All right, I have a little example here for us to look at as we see this formula for calculating straight line depreciation. So in order to calculate straight line depreciation, we need the item's total cost, so what it costs up front, the first time we purchased it. Then we need the item's estimated salvage value. So salvage value means if we were to sell the item today, what could we get for it in terms of fair market value? And then once you subtract that, you're going to divide by the useful life of the product. So how many more years do we have that we can actually utilize this item? If you have those three pieces of information, you can calculate straight line depreciation. Okay, so here's our scenario. The t-shirt gun used by a college athletic program costs $2,000, has a useful life of 10 years, and a salvage value of $500. I want you to calculate the yearly depreciation allowance on the t-shirt gun using straight line depreciation. So feel free to pause, try to calculate this one on your own, and then come back when you're ready and we'll go over the answer. Okay, so let's go through this one. So we know that in terms of the formula here, we have items total cost minus estimated salvage value divided by useful life will give us the depreciation allowance for that year. So we've got to plug in our numbers here. So we know the item's initial cost was $2,000. Who knew t-shirt guns were so expensive, huh? We need the estimated salvage value of the item. So that's $500. If the athletic program were to just sell the gun today, that's how much they would get for it, fair market value. And then we know the useful life is 10 years, right? So we plug that into our formula here. Go ahead and subtract the salvage value from the total cost. That gives us $1,500. Go ahead and divide that by 10. We get a yearly depreciation allowance of the t-shirt gun of $150. So that means that's how much we can deduct, or the athletic department can deduct for the depreciation value on this t-shirt gun. Again, you could apply this to really any asset that the sport organization owns, and obviously if they had a lot of other assets, this would be kind of a useful exercise in terms of tax time because it could save them money as a whole. Okay, so that's straight line depreciation. That's just another way of thinking about value and one of those standards of value for us to consider. All right, so I'm going to go ahead and pause here, and in the second video lecture, we're going to talk about the different approaches to actually valuing an asset.